Welcome to the deep dive. So today we're tackling the Buffett Indicator. It's basically a way to get a feel for the U.S. stock market's overall temperature, how it stacks up against the economy itself.
That's right. And we're going to unpack what it's telling us right now, especially with the latest figures.
Which are looking pretty high, I hear.
Yeah, quite high. As of, let's see, April 27th, 2025, MacroMicro has it pegged at around 185.4%.
185.4%. Okay.
And that number, well, definitely makes you pause when you look at the historical context.
Absolutely. So maybe just quickly, for anyone who isn't familiar, what exactly is this indicator? How does it work?
It's actually quite straightforward. You take the total value of all publicly traded U.S. stocks, that's the total market capitalization.
Right. Everything combined.
Exactly. And you divide that figure by the country's gross domestic product, the GDP.
The size of the whole economy.
Precisely. Then multiply by 100 to get that percentage. Warren Buffett, famously, back in a 2001 Fortune article, described it as probably the best single measure of where valuations stand at any given moment.
High praise indeed. So the rule of thumb is sort of over 100% means maybe things are overvalued, and under 100% might mean undervalued.
That's the general idea, yes. A simple benchmark.
And we're at 185.4%. That's quite a bit over 100.
It is. It definitely suggests, based on this one metric, that the market is significantly valued relative to the economy's output, and it warrants looking at past cycles.
Yeah, let's do that. What does it look like before, like, say, during the dot-com bubble?
Good example. Leading up to the crash in 2000, it peaked at around 159%. So yes, quite high then too.
Okay, but hold on. 159% then, and we're at 185% now. We're actually higher than the dot-com peak.
By this measure, yes, significantly higher. Then think about the lead up to the 2007-2009 financial crisis.
What happened then?
It got up to about 118% before the crisis really hit. Then during the downturn, it actually fell quite dramatically down to around 66.7%.
Wow, that's a huge swing. Shows how volatile things got.
It does. Stock values fell much faster than the overall GDP did during that panic.
And more recently, I remember valuations felt pretty stretched a few years ago.
They did. In 2021, during what some people were calling the everything bubble, the indicator actually went above 200%.
Remember 200. Okay, so 185.4% now is off that absolute peak, but still historically very, very elevated.
Extremely elevated, yes. It's definitely in that upper range, historically speaking.
So this is the key question, isn't it? When we see levels this high, like 185%, what usually happens next historically? Does it mean a correction is like inevitable?
Well, inevitable is a strong word in markets, but history does show a pattern. Very high readings on the Buffett Indicator have often preceded significant market downturns or periods of lower long-term returns.
It's because the market prices just can't keep outpacing the actual economy forever.
That's the underlying logic, yes. Eventually, there tends to be some kind of reversion or recalibration.
But crucially, and I think this is important for everyone listening, it's not a timing tool, is it? It doesn't flash red the day before a crash.
Absolutely not. That's a critical point. The market can stay what looks like overvalued by this metric for a very long time, years even. Think of it as giving you a sense of long-term risk or potential return, not a short-term trading signal.
Like checking the overall climate versus predicting tomorrow's weather.
Exactly that. And you also have to consider, structural changes. The economy isn't static.
How so?
Well, think about the rise of huge tech companies. They might have massive market caps, but perhaps a different kind of footprint on traditional GDP measures compared to, say, old industrial giants. That could potentially skew the indicator higher over time compared to decades ago. So direct comparisons aren't always perfectly apples to apples.
Right, context matters. Things change. So what's the main message for you listening right now? How should you interpret this 185% figure?
I'd say the key takeaway is this. The Buffett Indicator is currently suggesting, based purely on its historical relationship with GDP, that the U.S. stock market is significantly overvalued from a long-term perspective.
Caution flag for the long run.
Yes. But it's just one piece of the puzzle. It's a valuable perspective for sure, but you need to look at it alongside many other economic indicators, corporate earnings, interest rates, global events. The whole picture. Don't rely on any single metric.
Makes sense. So summing up, the indicator is high, suggesting long-term caution based on history, but it's definitely not a crystal ball for the short term, and the economy itself evolves.
Precisely.
So maybe a final thought for you to ponder after we finish up here. Given this long-term valuation picture from the Buffett indicator, what other economic signs or factors do you think are most important to keep an eye on over the next few months? Something to think about. Thanks for joining us on the Deep Dive.